Did you hear? While the promise to eliminate taxes on Social Security didn't make it into the final version of Trump's new tax bill, there's a powerful new provision that did, and it's poised to benefit millions of seniors. It's called the Enhanced Senior Deduction, and it's no small thing. If you're 65 or older, you could now receive an additional $4,000 tax deduction per person, stacked right on top of your standard deduction and the existing age-based deduction. For married couples filing jointly, that means up to $8,000 in extra deductions, a meaningful reduction in taxable income. But don't celebrate just yet. This benefit comes with some rules. The deduction starts to phase out for single filers at $75,000 of adjusted gross income, AGI, and for married couples at $150,000 AGI. And yes, this is a temporary provision scheduled to last from 2025 through 2028, so timing your retirement. Withdrawals wisely could be crucial. Let's pause for a second. Many people hear deduction and confuse it with a credit, but they're not the same. A deduction reduces the income you're taxed on. A credit reduces your tax bill, dollar for dollar. Understanding this distinction is key when evaluating how this new benefit affects your bottom line. So how does it all work? Start with your total income. This includes your Social Security benefits, pensions, IRA withdrawals, dividends, rental income, and so on. From there, subtract what the IRS calls above-the-line deductions. These include things like contributions to traditional IRAs, health savings accounts, HSAs, and self-employed health insurance premiums. What you're left with is your adjusted gross income, or AGI. AGI is a critical number. It determines whether you're eligible for many deductions and credits, including this new senior bonus deduction. Once you have your AGI, you subtract either the standard deduction or your itemized deductions, whichever is larger. The remaining figure is your taxable income, and that's the number the IRS actually uses to calculate how much tax you owe. Now, let's see how this new deduction plays out with a real-life example. Let's say you're a married couple filing jointly with $40,000 in IRA distributions and $50,000 in Social Security benefits. Under the current tax rules, with no new senior deduction, your taxable income would be $30,650, leading to a federal tax bill of roughly $3,210. But with the new senior bonus in place, your taxable income would fall to $22,650, and your tax bill would drop to just $2,065, saving you nearly $1,000. Now imagine if Social Security benefits had been made completely tax-free, like some originally hoped. In that scenario, your taxable income would shrink to just $6,800, with a total tax of only $680. While that would have been the ultimate win, this new deduction still delivers real savings. Let's raise the stakes. Suppose you receive $60,000 in IRA distributions and $65,000 in Social Security benefits. Currently, that would generate about $74,000 in taxable income, resulting in a federal tax of $8,400. Add the senior deduction, your taxable income drops to $66,025, cutting your tax to about $7,400. Again, shaving nearly $1,000 off your tax bill. And if once again, Social Security were entirely tax-free, your taxable income would have been only $26,800, with a tax liability of around $2,139. The comparison makes one thing clear. Even though full Social Security tax exemption didn't pass, this enhanced senior deduction still offers meaningful savings, especially for those who manage their income to stay under the AGI thresholds. As this legislation moves through Congress, you can bet I'll be right here breaking it down, explaining exactly how these changes affect retirees, Social Security recipients, and anyone approaching retirement. So if you haven't subscribed yet, now is the time. There are more updates coming. that could significantly shape your retirement strategy. Thanks so much for watching, and stay tuned.